My name is Nathan Goldman. I'm an assistant professor here at the Poole College of Management at NC State University, and it's my privilege to present this paper titled The Inherent Conflict Between Progressive Tax Rates and Income Inequality, Lessons from COVID-19 Restrictions. This paper is co-authored, and I always like to throw my co-authors under the bus here, with some pictures co-authored with Stephen Lush, who's at TCU, and Gil Sadka, who's at the University of Texas at Dallas. So a little bit about this paper. I'm going to take a few minutes here to just kind of back into why we're looking at this topic. So this figure right here is looking at the anticipated revenue shortfalls across 27 July 1st, 2020. So here we are 3 months into the pandemic, and already states are starting to come up with their conditions of what they're operating at. You know, we've had a rough few months, there's been restrictions, there's been lockdowns. Across the next 2 years, about $114 billion shortfall in their revenues relative to prior years. So we're starting to see this very dismal picture being painted that states aren't going to do too well during this COVID-19 pandemic. Now, from the same article, we could see this quote here that says, if anything is certain, it is that revenue shortfalls will force states to make tough choices. Employees. So already we're starting to see some concerns arise about what is the condition of these states during the COVID-19 pandemic. Now we could fast forward about a month here and we start to see some of these outlooks being put together. So this is the change in monthly revenue versus the previous year, and it's aggregated across all the states. We can see the US line being put here in bold, but each of these other grayer lines are kind of these other states. And we can see on average, states are having significant revenue shortfalls relative to the previous year. One of my favorite things about this article is that these quotes that are put in here, with dwindling cash cuts to education, healthcare, and other areas are inevitable in many places, state leaders are describing the situation as rough. And I'm going to put a couple of these quotes in bold here. Florida's Republican Governor Ron DeSantis compared his state's budget cuts to the red wedding scene of HBO's Game of Thrones, which if anyone's watched Game of Thrones, you know that that's not exactly a positive outcome. And then the Maryland Governor Larry Hogan said responding to this crisis has created a multi-year budget crisis unlike any other, and even says it could be about 3 times worse than the Great Recession. So states through 4 or 5 months here in the pandemic are already starting to say this is going to be really bad. We're very concerned with what the situation is right now. And this has led to about 6 or 7 months later with Joe Biden's American Rescue Plan Act of 2021. This has led to the federal government to actually infuse significant amounts of cash from the federal government to the states. So we could see some of these different items here. California received $42 billion. Texas received $27 billion, and on the line. So we're seeing these states get significant amounts of money from the federal government because their situation is going to be so bleak. But one thing that was very unique kind of arose out of all this. And this is when we fast forward all the way to March 1st in 2021. This is a New York Times article. And what we could see is that many of the states not only didn't have a decline in revenues during 2020, they actually increased their tax revenues in 2020. So all these states that are here in blue, including our state of North Carolina right here, actually had higher revenues than the previous year. So we have 2 different stories going on here. We have one story that says this is going to be like the red wedding from Game of Thrones. And then we have another story that actually shows that approximately half the states actually increased their revenues. And if you look at the states that even had a modest decline in revenues, it's pretty much the majority of the map here. A couple states like Texas and Florida and Alaska and Nevada and Oregon had significant declines, but overall, we could say that this is mostly either a flat set of revenues from one year to the other, or states actually increased their tax revenues. So just to summarize, 3/11/2020, the COVID-19 pandemic was declared. We had states that feared financial ruin for nearly a full year and put out very grim articles about what their prospects will be. And then on 3/1/2021, revenues far exceeded expectations. So part of what we're looking at in this paper is what are some of the factors that led revenues to exceed expectations during that first year of the COVID-19 pandemic. Now, to kind of put it more formally in terms of our research paper here, we are looking at whether progressive tax rates and income inequality, so these two factors that we're proposing are going to help explain that situation, whether those affected states' financial health. And we're going to proxy for progressive tax rates and income inequality by looking at states with progressive tax rates and income inequality using the COVID-19 pandemic, because that did affect income inequality. And we're going to look to see how that affected the state tax revenues. And our research question is, did the state's progressive tax rates and income inequality during this COVID-19 pandemic affect or aid, I should say, state tax revenues? Now, a little bit of background about this research paper, this research question. Tax systems are a function of revenue needs. So we have taxes because we need to fund our federal government. We need to fund our state governments. But we don't only look at revenue needs when we set what our state taxes are going to be or we set what our tax rates are going to be. We also have to consider several other important factors like social concerns, equity concerns, political considerations, other economic considerations. So there's lots of different factors that kind of come into this piece here to help shape our tax system. Now, one of the most common features, and the one that we're going to be focusing in on today, is this idea of a progressive tax rate structure. And the idea around that is that someone that earns less income is going to pay taxes at a lower rate relative to someone that earns more income. To help demonstrate this, we could always look at our tax bracket table. So here's the tax brackets for the 2021 tax year at the federal level. And we can see that if you are a single individual and you make less than $10,000, you're only going to pay a tax rate of 10%. Meaning the next dollar of income that you earn is you're going to pay 10 cents of it in your federal income taxes. Meanwhile, if you're an individual and you make over $523,600, then the next dollar of income that you have, you're going to pay 37 cents to the federal government. Now, the focus of our paper is not necessarily on the federal tax rates, it's actually on the states. And states often also have these progressive tax rate structures. The most progressive is California. And we can see here California for single filers, if they make between $0 and $89,032, they have a state tax rate of 1%, meaning every additional dollar they pay 1 cent in taxes. But if you make in the higher numbers, it's the $559,013 or more, then you pay 12.3% in your taxes. And if you make over $1 million, then you actually add another 1% on top of that. So California has a very progressive tax rate structure. Now, some states don't have any state taxes. So we can see that with states like Texas and Florida and Nevada. And some states, like North Carolina, actually have a flat rate, meaning everyone pays the exact same amount regardless of your income level. And we'll look at some of the variation in that in our paper. But California is just a perfect example here of a progressive tax state. So to kind of help further illustrate what exactly this progressive tax rate structure means, let's say you are an individual and you live in California and you increase your AGI, your adjusted gross income, by $100. Now, if you were making $5,000, meaning that your new adjusted gross income is $5,100, then your tax liability is going to increase by $1, meaning that from that $100 increase, your additional tax liability, the additional amount that you pay in taxes to the state of California is just $1 higher. Now, if you're an individual who makes $1 million and you have that exact same $100 increase in your adjusted gross income and the income that you bring in that's considered taxable, then you're going to increase your tax liability by $13. So the same $100 yields a 1,300% higher tax liability increase to the state of California, depending if you were in the lowest tax bracket versus the highest tax bracket. And this concept is often referred to as vertical equity. I'm not going to go into the details on things like vertical equity or horizontal equity, but the idea of vertical equity is we're outlining here in the progressive tax rate structures is that an individual that just has more ability to pay taxes, that makes more money, should be paying more in taxes. And that's exactly what we can see here with the progressive tax rate structure. Now, we can illustrate this idea of how income inequality and progressive tax rate structures really kind of coincide with one another by, again, using this California example. So let's say in California, there are 10 taxpayers each making $200,000, meaning in total there's $2 million of money that's being earned. Each taxpayer is going to be in that 9.3% marginal tax rate bracket. And what it's going to result in is $186,000 in total tax collections. Each taxpayer is paying $18,600. But let's flip this around. Let's say instead of everyone making approximately the same, being a very equal situation, equal world, we have an unequal world, a situation where there's high income inequality, and there's one taxpayer that's making all $2 million, and the other 9 make absolutely nothing. So the other 9 are paying $0 in taxes because they don't have any income, but that one individual that makes $2 million is paying taxes at the 13.3% tax rate. This individual is going to have $266,000 in total tax collections. So one of the things that we're going to bring forward in our paper that we're going to use to help speculate as to why there was large increases in tax revenues is that when you do have this income inequality in a progressive tax rate structure, it will actually lead to more income tax collections relative to if you have less income inequality or non-progressive tax rates. All right, so why is the COVID-19 pandemic a great situation to look at income inequality? Well, one thing that really came about was these restrictions. Restrictions were put on where you could go. Restrictions were put on what you could do, where you could work, how you could work. And it really led to this divergence in terms of income, in terms of wealth among those who had high income versus those who had low. And this Washington Post article really helps highlight this. This quote, low-wage jobs were lost at about 8 times the rate of high-wage ones. The devastation was deepest among the lowest paid, but middle-class workers were not spared. A clear trend emerged: the less workers earned at their job, the more likely they were to lose it as businesses around the country closed. And even thinking about this from a, just a applied sense, people that had these higher income jobs, odds are they could just sit at their home on Zoom and they could work. They could tap into their company's systems and use computers to really do their jobs. But when you think about the lower income workers, the ones that are working at restaurants, the ones that are working at dry cleaners, the ones that are working at cleaning office building, whatever it might be, their jobs weren't necessarily there during the pandemic. So even though that's one just extreme example, that really helps illustrate why this article is spot on in terms of where this would affect income inequality. There's actually been quite a few academic studies that have arisen out of this too. So we actually have a series of studies, and I could kind of go through these real quick, but 37% of jobs can be done at home, and these jobs usually pay more. So that was kind of an early pandemic study that said, okay, some of these jobs can be done at home, but these are the higher paying ones, not the lower paying ones. You can't clean your office building from home, right? That's only an in-person type job, but you could still be engaging, processing transactions and doing mergers and acquisitions from home, right? That's something that can be done remotely. Another one here, working from home sheltered some workers from job and earnings losses. Women and less educated workers were more affected by the COVID-19 crisis. This was a Journal of Public Economics paper, and it really helped show this, again, this divergence in inequality that resulted from the pandemic. Unemployment rose for everyone in March of 2020, but significantly declined among the white population, but didn't change for the non-white population. That's something that came from Couch et al. 2020. We have another state-level policies caused 12.4% increase in unemployment insurance claims. Again, another issue that comes from income inequality. And lastly, and this is the last of 5 JPUB articles I could cite, but the lowest income quintiles and minority ethnic groups have the worst labor market shocks due to the COVID-19 pandemic. So all these come together to say there is this income inequality that stemmed from the COVID-19 crisis. And I wish that I was on some of these papers, I could speak more to the very specific details, but it's very compelling evidence across the board that this is the clear trend that emerged from this pandemic. So if we bring this all together, COVID-19 significantly increased income inequality. I think we could say that resulted from this crisis. We also have that great income inequality increases income tax collections, and that's something that we could show just mathematically from a formulation, just using algebra, that this is something that would happen. But we could also see that this relation is moderated by how progressive the tax rate structures are. So putting all 3 of those statements together, we hypothesize that if COVID-19 significantly increased income inequality in the United States, then states with more progressive tax rates will have greater tax collections than the states with less progressive tax rates. And as a corollary to this would help explain why some states perform so well during the COVID-19 pandemic relative to others. So in terms of our research design, we're really focusing on the individual income tax receipts. So we call this variable TR per cap, which is the tax receipts as a percentage of the total population, so how much each person is paying in taxes on average. And we get this data from the US Census Bureau. And then our two independent variables that are capturing this progressive tax rate structure are going to be first MAE, which is the multiple of average earnings, which the top state individual income tax rate applies. So if we think about California, their tax rate is 13.3% for all income over $1 million. Their average income is $53,000, so their MAE is a very high number. It's 19 for their multiple average earnings. We also look at PROG, which is another variable that captures progressive tax rate structure, and this is the difference between the top individual income tax rate and marginal tax rate on $25,000. So California's top marginal tax rate is 13.3%, and if you made $25,000, your tax rate is 4%. So that PROG variable would be 9.3. It's the difference between those variables, and that's also the highest among all of our states. So I just use California as just a good example to say, okay, here's kind of how it would look. If we think about a state that had zero tax rates, then their PROG would be zero. And if you think about a state that has a flat tax rate, then their PROG would also be zero. So a state like North Carolina has a zero for progressive, but they have a smaller amount for something like MAE, the multiple average earnings, relative to a state like California. We include quite a few control variables just to kind of help capture these other alternative explanations. We first control for statewide income inequality. We also look at the gross state product per capita. We look at some state variables such as what's the legislative, what's the governor's setup, and if they're both Republican controlled, that can help dictate some of these policies, so we control for that. We look at things like the state earned income tax credit and also whether there's some sort of initiative or referendum process that the state has. Throughout our analysis, we include year-quarter fixed effects just to help control for these time invariant changes. And what we expect on this first test here, this is independent of the income inequality, but we expect that if tax rates are increasing in income tax progression, then the coefficient on beta 1, this progressive tax rate, is going to be positive and significant. Now, when we get to our research question here, we're really going to focus on these different COVID-19 restrictions, these different levels of income inequality that arose directly related to the COVID-19 pandemic. And we're going to look at two variables. The first is called low MI, and this is the mobility index. We get this from the Federal Reserve Bank of Dallas, and what it is they use cell phone ping data to help identify how much people are moving around at different times, with the idea being that if all of a sudden you're moving less, if you're not moving as much, then you are likely in a situation where you're being restricted, and therefore you're being affected by these COVID-19 restrictions. The other variable we use is called high RI, and this is a composition of 12 different ways states impose restrictions. I'll kind of walk through some of them, but it's things like, is your state under emergency order? Is your state closed its bars and restaurants? Does your state close daycares? Things like that. To help illustrate this mobility by quarter, we can see in 2020, this is what Q1 looked like. Every state was pretty much in a open situation, right? We didn't have a pandemic until March. But as we go on, we could see that some states, the mobility significantly decreased. So we'd expect a state like Washington to have some of the lowest mobility or the biggest mobility decrease in Q2. They were one of the first states hit by this pandemic. They generally have pretty conservative policies when it comes down to these things. Also, states like New York had big decreases in mobility. But then we get seeing Q3 when the pandemic started letting up a little bit. Those states started letting up a little bit more, but really it's these other states, these more like the Iowas and the Wyomings and the North Dakotas and South Dakotas that actually had more mobility relative to some of these other states. So we could see as a variation that resulted once we started considering things like mobility, that this mobility does capture, in general, how restricted things are going to be at these individual states. To really help show what this mobility looks like, this is all the states aggregated together by looking at the mobility across all the different jurisdictions. And as we can expect in March, right in that March window, there's a significant decline in mobility all throughout the country. But even within that mobility, there's great variation. Some states had much bigger mobility declines than others. And we can see even that with these blobs forming that there's just wide variation in how much mobility declined across each of these individual states. So we do feel pretty good that this is capturing something related to COVID-19 restrictions. We also did a little bit of analysis just to really help validate this by looking at 4 situations where we had 2 states that bordered one another, one that had much more conservative policies relative to the other. So we could look at, for example, Iowa versus Illinois. Iowa had some of the least restricted policies when it came down to the COVID-19 pandemic. Illinois had some of the more restricted. And we can see how their mobility decline differs. So they both had a significant decline in that March period, but the decline was much greater for Illinois relative to Iowa, all the way across the board. Similar to South Dakota versus Minnesota, Nevada versus California, Tennessee versus Kentucky. We just noticed these clear differences among mobility depending on how restricted these states were relative to their neighbors. But of course, mobility index, that could be a little bit noisy if we really wanted to drill down on it. So we have another proxy, which comes from the Raifman et al. Restriction Index. And this is a series of 12 questions that we asked, or I should say they asked. And the first is there a state of emergency declared by the governor? Is the state ordered daycare closure? And on down the line. And these are 1-0 questions. We also had 4 questions as part of this index that were more than one variable. So for example, school closures, there's an option of 2 if the state ordered closure or partial closure or online only, and 1 if within the state it allowed it to vary by district, and 0 if the state mandated that the people had to be there in person. So we allowed some variation depending on how restricted those states were being. So we include these 2 variables as interaction terms with our progressive tax rate structure. So we take the MAE and the progressive tax rate structure and we interact that with our low MI variable, which is the low mobility index, or high restriction index, because those are opposite terms there. And we interact those 2 together to form our 4 main tests of our hypothesis. In terms of descriptive index or descriptive statistics, what we really have is that on average, taxpayers pay about $346 in state income tax collections. And it really does huddle around the middle there in terms of, varies across our range from $234 to $436. But of course, in states like California, that can get much higher. So we do have some variation there within that. On average, taxpayers aren't really changing their tax rates per capita quite much between 2019 and 2020. It's only on average about 10 cents difference. So this is a tight window here that we're looking at. And really most of our variables are just kind of in line with our expectations beyond that. To help provide just some univariate evidence just to show that at least that baseline projection, that the more progressive your tax rates are, the higher tax collections are going to be, we look at these different buckets here. So we take our rank MAE, so we take our multiple average earning variable, and we just put it into 3 terciles. Same with how progressive the tax rate is. And then we look at how the tax rate per capita varies across these different buckets. And what we can see is that on average, these states that have higher MAE, high progressive tax rate structures, do have greater tax collections relative to the states that had low progression. And we could show that here with our multivariate evidence when we look at the tax collections and income tax rate progression. Across all the variables here, we do see that they're significantly and positively correlated with our tax rates per capita. And I know this can be a little small, so I zoomed in here. I zoom in on the next one. So this is the main table, though, that we're really focusing in on. So we have that baseline expectation that there's going to be, the more progressive your tax rates are, the higher tax collections are going to be. So now we want to see how this interacts when we start bringing in some of these COVID-19 restrictions. And again, we look at these interaction terms. How does MAE interact with a state that has low mobility index? How does MAE interact with a state that has high restriction index? And I want to zoom in just so it's more easily can be seen. But we can see that the tax rates per capita, or the tax collections per capita, are positively associated with states that have higher income tax progression and also have more COVID restrictions. And that's consistent across all 4 of our tests here. So regardless of whether we use MAE or PROG, or whether we use low MI or high RI, we see that there's a positive correlation. So this perfectly captures what we were expecting, in the sense that we were expecting there to be a positive relation between these tax collections and the interaction of how progressive your tax rates are and how restricted your state was during the COVID-19 pandemic. Now, interaction terms can be a little tough to consider sometimes, so what we then do was we split out just who were the firms that had low MI equals 1 and who were the firms that had low MI equals 0, and we could see that those firms that had that low mobility, that's where the progressive tax rate structures really kick in. In fact, it essentially goes the opposite way when we look at firms that had low COVID-19 restrictions from the mobility index, but we see it pretty consistently across each of our tests that the results are being driven by these states that had the high COVID-19 restrictions relative to just the states that were relative to whether it's being driven by the states that had low. We also look at a changes model, so we look at the change in our tax collections, regressing it on these different interactions of the COVID-19 restrictions and the income tax progression, and even that changes variable loads. So in a lot of ways, this is just such a powerful test because it could really help show that this relation is being driven by the changes in what they're occurring between 2019 and 2020 rather than just a levels test. Now, in general, we're very careful to not say that this is anything more than an association study, but at least this does kind of help mitigate some of those concerns about potentially a correlated omitted variable or any sort of endogeneity concerns by being able to show that changes specification. And results also hold when we split this out on the low versus the high test as well. And lastly, and this is something that we found that was really interesting here, was just taking the tax collections out of the equation. What if we just consider this idea of, well, how did their restrictions, how restricted they were during the COVID-19 pandemic, how did that relate to the degree to which their tax collections or their tax rates are progressive? And what we can actually see is that these results are significant. We could see that the states that had more progressive tax rates tended to have lower mobility index. Remember, that's kind of an opposite signed item. Or they have higher restriction index. Now, we don't go as far to say that states considered this or this was a primary consideration when they were setting these restriction policies. But it does provide some credence to the theory that perhaps states were concerned about their bottom line, that states were concerned that we are going to be in financial ruin through the COVID-19 pandemic, and if we're a state that has high income tax progression, perhaps more restrictions would be an opportunity for us. We can't find any anecdotal evidence that says that they really considered this as a primary consideration, but we at least believe that this kind of helps connect those dots, that these kind of help show that this probably played into their incentives in some way, either directly or at least indirectly, that they were considering this. So our main conclusions, the first, progressive tax rates are positively associated with income tax collections. And again, I could show that algebraically, right? We already showed that just by looking at the numbers, looking at how this might be, but at least we were able to connect the dots and really start out with that as a baseline association, that the more progressive tax rates you have, the higher income tax collections that you end up having. We then show that income inequality, be it the COVID-19 restrictions, did significantly increase income tax collections in the states with the higher income tax progression. And we show that across two different proxies for income tax progression, as well as two different proxies for how restricted the states were when it came down to COVID-19. And then lastly, we show that the states with the more progressive income tax rate structures instituted greater COVID-19 related restrictions, which we believe might at least provide some indirect evidence of this having incentives for those legislators, for those policymakers in each state. In terms of contributions, I think the biggest one is clear, that we really help link these two questions that were lingering. Why did states have this sudden increase, or at least a flat relation between their previous revenues and their current revenues during the COVID-19 pandemic? And we could provide this answer as a function of income tax rate progression and income inequality. We also extend the role of taxation in the face of income inequality. And really, I think one thing that's kind of neat about this paper that could be a neat opportunity is we could now provide opportunities for the US to learn how to expand income tax collections in the face of this ongoing pandemic. We're starting to see, even as of this morning, states are talking about raising these final, maybe less significant mandates that are going on with terms of face masks, things like that, that this could help enhance our, or lower our income inequality But it could also be useful as we move forward and we're trying to address significant capital market situations in our country, like the national debt that we have that just went over $30 trillion. This is something that we could use to at least help understand how income tax collections interact with these progressive tax rate structures. Now, most of our presentations in the accounting field tend to only be about 15 or 20 minutes. I was able to make this about 30 minutes, so I'm going to go ahead and pass it off now to any questions that might be out there. But I did want to just take a moment to thank you all very much for your time and look forward to any comments or feedback. And if we have to end early, then that's fine by me too. Thank you.
Nathan?
Yes?
I have a question. You might have to repeat it back for the video.
Yeah.
In the equality, you know, the pandemic caused greater income inequality because the bottom end of the income market dried up. But that wouldn't drive higher tax revenues, right? Unless the higher income people made more money.
Yep.
So what evidence do you have that it's not just that the people staying at home actually made more money? Because that is a necessary condition, right, for greater tax revenues rather than just the lower income people not paying taxes.
Yep. And so the question was, in the face of income inequality and the higher tax collections, we actually needed the higher earning individuals to make more money during the pandemic in order for this to really come full circle. And I think, maybe it's something we need to put in the paper, because I think this is a really good point, that we do need to show that there was a significant increase in those higher earning individuals. And I think anecdotally we can show that, because I think among the CEOs and CFOs, they got big bonuses. They were able, especially when the stock market dropped, they were able to exercise more of their stock options during that time and really increase their income during that period. So I think that is something that we should, at a minimum, provide some anecdotal evidence as to why this, kind of completing that puzzle. But because I agree, it seems like the lower earning individuals had I think that's clear that they had a much, I always hate to say they had a much lower earnings during that period, but that doesn't necessarily explain the other piece of it. And I think some of it that we could provide too would just be at least considering maybe empirically the change in the GDP during that time, where the GDP actually, I mean, there was one quarter where it was pretty bad during that period, but the remaining quarters it actually did quite well in 2020, and that can kind of help. So we have some anecdotal evidence that we could show with these executives that made a lot of money, but then we could also get GDP and show that didn't drop off quite as much as we thought it was going to. Perfect. Yeah, thank you. Yeah.
So if I understood correctly, you were arguing that having more progressive tax rates both induced state policymakers to implement more restrictive public policies in response to COVID and moderated the effects of those policies.
Mm-hmm.
So if that's correct, I wondered if you have anecdotal evidence that suggests that the policymakers making the decisions about responses to COVID actually understand this relationship between their tax structure and the impacts of those restrictions.
Yeah, that's a great question about whether and I'm repeating a little bit for the video feed. So the question is that if there was actually a change in the policy that benefited the states, is there any way we could show that the states knowingly knew about that and enacted these more stringent policies to try to increase their tax collections? We did do a pretty thorough search, and we couldn't find anything that showed that the states knowingly put in more restrictions just for this. And I think part of the reason why was because their main focus on this was public health. And I completely agree. And I mean, I even think back to the early days of the pandemic, every day looking for a Roy Cooper news conference with the DHHS representative, and seeing what the new updates were and what restrictions were going to be happening, especially with having kids in daycare at that point. I was very interested in knowing what daycare was going to look like. And they always put public health as the number one factor. But what we think might be happening is that there was that indirect incentive, that they didn't necessarily lead with this idea of, okay, we need to protect our tax collections, but that they did have that in the back of our mind of, hey, if we put in more restrictions, this might actually help us shelter from having a big downside tax revenue hit throughout the year. So long story short, I don't think we could, ideally we'd be able to show exactly what you said. And I agree that's probably something that would really help out, but we just couldn't find anything that connected those dots.
That's one more question?
Yeah.
So now extrapolating what you found to the next phase, so would it be correct to predict that as restrictions are reduced, you might hope that that's going to increase economic activity and increase tax revenues, and predict that that will be more true for states that have less progressive tax structures?
Yes.
If you've got a more progressive tax structure, you're less likely to benefit from an economic bump from reducing COVID restrictions.
Yeah. Yes, and that's exactly what we're we're predicting that. And I think if we went out one more year, because we really focus on 2020, because that's where the biggest variation in the restrictions were. But the question being of now that restrictions are unwinding, now that we're having fewer restrictions, are we going to expect to see the greater benefits persist for those states that have the less progressive tax rate structures? And that's exactly what we'd expect across essentially 2021 and into 2022 as these restrictions really eased. One of the tricky things with 2021 as well, and one of the reasons why we don't focus as much time there yet, is just because these restrictions were a lot more volatile, just depending on when Delta was coming out and then when Omicron came out later on in the year, and the different, it seemed like we relaxed them for it felt like one day, right? But really it was maybe like 6 weeks or so, and then we went back to it. So because of how volatile those were, it's a little harder to capture. But we'd expect that a state like North Carolina, which is kind of in the middle, doesn't have no income tax collections, but it also doesn't have a very progressive tax structure. We'd expect a state like North Carolina that had these high restrictions, as they relax them, that they would get a greater benefit in terms of their income tax collections during a year like 2021. And I believe that's kind of what we saw, at least looking at the data, that states like North Carolina, more of these flat rate states actually did do quite well in 2021 relative to the states that had more progressive rate structures. All right. Well, I do want to thank you all so much again for your time, and thank you again to the organizers for putting on this great conference. And any follow-up questions, please feel free to reach out to me, and I'd be more than happy to chat more about this topic. Thank you.